Bond yields are the pulse of the global financial system, and for Forex traders, they are the single most reliable leading indicator of currency strength. When you trade currencies, you are essentially trading the relative health of two economies, and nothing reflects that health more directly than the interest rates on their government debt. The yield on a bond is simply the return an investor gets for lending money to a government, and that return is priced by the market every single second. The core mechanic is brutally simple: capital flows to where it is treated best. When a country's bond yields rise, it means investors are demanding a higher return for holding that country's debt, or they are selling the bonds for a reason. But from a currency perspective, a rising yield acts like a magnet for foreign capital. Global investors will sell their own currencies and buy yours to access that higher yield, pushing your currency's value up. Conversely, when bond yields fall, the attraction fades. Investors pull their capital out, sell the currency, and its value drops. This is not a theory, it is a daily flow of hundreds of billions of dollars. Let's look at the crown jewel, the 10-year Treasury yield. The US dollar is the world's reserve currency, and the 10-year note is the benchmark for global borrowing costs. When the US 10-year yield climbs, the dollar doesn't just strengthen against the yen or euro, it strengthens against almost everything. Why? Because the US is seen as the safe haven, and if you can get a higher yield in the safest market in the world, why would you park your money anywhere else? So, when you see the 10-year yield breaking out to the upside, the USD pairs are going to follow, often with a vengeance. You need to understand the anatomy of a yield move. A yield increase can come from two very different sources: rising inflation expectations or a stronger economic outlook. If inflation is rising, the Fed will hike rates to cool it down, and that hikes yields too, and the dollar will rally because higher rates are coming. But if yields are rising because the economy is booming, that's also bullish for the dollar because it means productivity and growth, which attracts even more capital. The point is, for the Forex trader, the direction is what matters first. Rising yield equals rising currency, regardless of the initial spark. The inverse is just as critical. Falling yields are a red flag for a currency. This usually happens when the market expects the central bank to cut rates, or when there is fear and investors flee to the safety of other assets. For example, if the US 10-year yield drops sharply, it signals that investors are worried about a slowdown or a crisis, and they are buying bonds, not selling them. That buying pressure pushes yields down, but it also signals weakness in the dollar. A falling yield is your cue to sell the dollar against currencies where yields are stable or rising, but do not look at the yield in isolation. The spread is the trader's real weapon. You must compare the US 10-year yield to the 10-year yield of another country, say Germany or the UK. If the US yield is rising while the German yield is flat, the spread widens, and euro to US dollar will fall. That is the trade. The absolute level of the yield doesn't matter as much as the differential. If the US yield is at 4% but Germany is at 2%, the dollar will still be bid because the spread is favoring the dollar. You are not trading economics, you are trading the spread. You must also respect the timing. Bond markets are open nearly 24 hours, and they move before currencies do. Watch the 10-year yield in real time on your chart. When you see a sharp spike up or a breakdown down, do not wait for the news headline, act on the yield move. Currencies lag bonds by minutes, sometimes seconds, but they always catch up. A sudden move in the 10-year yield is a gift. It is the market telling you the dollar's direction before the rest of the crowd sees it. Your mission is simple. Every trading day, before you look at any currency chart, open the 10-year Treasury yield chart first. Is it making higher highs? Then the dollar is your friend. Is it making lower lows? Then the dollar is your enemy. Use the rising yield as your buy signal for USD pairs, and the falling yield as your sell signal. This one metric, used correctly, will filter out the noise and align you with the biggest capital flows on the planet. The bond market speaks first. Your job is just to translate it into a currency trade.